In this video, we're going to focus on the math behind buying and selling call and put options. Now let's start with the call option. The call option is basically a contract that gives the buyer the right to buy a stock at a certain price. The value of the call option depends on the share price of the stock, that is the underlying asset. It depends on volatility, that is how much the price of the stock is moving. Some stocks, they don't move much, so they're not very volatile. Other stocks, they have huge price swings, and so they're very volatile. And also, the price of the call option depends on how much time is left to expiration. So what happens to the value of the call option if the value of the stock goes up? If the value of the stock goes up, the value of the call option goes up as well. Specifically, the intrinsic value of the call option. A call option has two components, the intrinsic value and the extrinsic value. Now, what about volatility? As the stock becomes more volatile, what happens to the value of the call option? As volatility increases, the value of the call option goes up. More specifically, the extrinsic value of the call option. And the last thing to consider is the time to expiration. Every call option and every put option expires at some point in the future. As the time to expiration decreases, the value of the call option goes down. Now, this is known as time decay, and time decay only affects the extrinsic value of the call option, not the intrinsic value. So the intrinsic value of the call option depends on the share price. The extrinsic value of the call option is affected by volatility and time decay, how much time the contract has before it expires. Now, before we continue with this math problem, I do want to mention something, and that is that I'm going to be posting a few links in the description section below in this video. Now, this is for those of you who may want more stock-related video content. Let's say if you want to understand the math behind calculating certain financial ratios such as price to earnings, earnings per share, market capitalization, dividend yield, return on equity, and other things like that. Feel free to take a look at the description section below if that interests you. So now let's move on to this problem. Number one, John buys a call option with a strike price of $40. The price of the call option is $5 with a 3-month expiration date. The market price for the underlying asset, that is the stock, is $43. Part A, what is the total amount of money that John paid for the call option? Well, first, remember the call option is a contract that gives the owner the right to buy a stock at a certain price. In this case, at the strike price. So at any time, John can exercise his right to buy the stock at $40. But to obtain this right, he has to purchase the call option, which is currently selling for $5. And this call option is only valid for 3 months. In 3 months, it will expire. So now, how can we determine the total amount of money that John paid for the call option? Is it simply $5? The answer is no. One option contract controls 100 shares of stock. So when John buys a call option for $5, the total amount of money that he's spending is 5 times 100. So he is spending $500. This is the maximum amount of money that he could lose on his trade. So this is his maximum risk. Thus, for option buyers, their risk is limited. Their potential reward is unlimited, but they have limited risk in buying options. So that's the answer for part A. Let's move on to part B. What is the intrinsic and extrinsic value of the call option? Let's start with the intrinsic value, and I'm going to use the letter I to represent that. The intrinsic value is the difference between the price of the stock, also known as the share price, and the strike price of the call option. So in this example, the price of the stock is $43. The strike price is $40. So the intrinsic value of the call option is $3. So as was mentioned before, the intrinsic value of the call option is dependent on the share price. The strike price of the call option is fixed. It's always going to be 40 based on the terms of the contract. That's not going to change. But as the share price increases, the intrinsic value of the call option will go up, as was mentioned before. But now let's understand what the $3 mean. Why is the intrinsic value $3 other than the fact that the equation told us so? Well, what John could do is he can exercise his right to buy the stock at the strike price at $40. And then he can go to the market and sell the stock at the market price of 43. And so he could immediately realize a gain of $3. That's if he wants to exercise his right. That is if he wants to exercise his right to buy the stock at this point. However, he paid $5 for the call option. And so if he exercises his right to buy the stock at a lower price, he's going to have a net loss of $2. So right now, it's not in his interest, or rather, it's not in his best interest to exercise his right to buy the stock at $40. And we could see that the net loss is equal to the extrinsic value of the call option, which is also known as the time premium. It's basically the value of the time and the volatility that is in the call option. So now let's get rid of this and let's calculate the, let me say that again, extrinsic value of the call option. For some reason that just doesn't want to roll off the tongue smoothly. But let's move on to the second part of part B. Now to calculate the extrinsic value of the call option, what we need to do is take the price of the call option and subtract it by the intrinsic value. Let's simplify this equation. Let's use C for the price of the call option. Because keep in mind, the call option is the sum of the extrinsic value plus the intrinsic value. John paid $5 for the call option, and we know that the intrinsic value is $3. So therefore, the extrinsic value is $2. So the $2 in the $5 call option has to do with the time premium, that is the 3-month expiration date, and also the current volatility of the underlying asset or the stock. Options are derivatives. Their price is based on the underlying asset. So as volatility increases, the extrinsic value of the call option increases. And as time moves forward, that is, as time to expiration decreases, the extrinsic, I always say that wrong, extrinsic value, that's going to decrease as well. But also, as volatility decreases, the extrinsic value decreases. So let's say if you buy a stock, if you buy a call option when the stock is moving a lot, that is when it's very volatile, and then it cools down, that is when volatility decreases, the call option will decrease in value. So thus, it is wise to buy a call option when volatility is low, but to sell it when volatility is high. You don't want volatility to work against you when buying call options. So now let's move on to part C. What will be the value of the call option if the price of the stock at expiration is, let's say, $35 to start? So what do you think we need to do? Feel free to pause the video. So first, let's calculate the intrinsic value. The intrinsic value, as was mentioned before, is the difference between the share price and the strike price of the call option. The share price is now $35. The strike price remains at 40. So notice that we get a negative number, -5. However, the intrinsic value of a call option is either equal to or greater than 0, which means it can't be negative. So if the share price is less than the strike price at expiration, the intrinsic value is 0. So that's the answer. Well, that's the first part of the answer. Now we need to determine the extrinsic value. At expiration, the extrinsic value is always 0. And we know the price of the call option is the sum of these two, the intrinsic and the extrinsic value. So this particular call option will expire worthless at expiration. It's not going to be worth anything. So when the share price goes down, the value of the call option goes down. In order to profit from a call option, you need the price of the stock to go up. So buying call options is profitable in a bull market. Now, for those of you who want to learn how to find stocks that are going up, I've posted a video on my Patreon page, and here is the link. It's a very brief video. It's very straight to the point, and it quickly shows you how to find stocks that are going up. So feel free to take a look at that when you get a chance, and let's get back to the video. Now, what about if the stock closes at $40 at expiration? What is the value of the call option? So feel free to pause the video and go ahead and calculate the value of the call option based on what we just did. So the share price is 40, the strike price is 40. So therefore, the intrinsic value is still 0. We know that the extrinsic value is still 0, so therefore the call option will be worth 0. In order for the call option to be worth something at expiration, the value of the stock has to be greater than the strike price. If it's equal to or less than the strike price, the call option will expire worthless. So now let's consider the third scenario. Let's say the stock went up from $43 to $50. In this case, what is the value of the call option? So the price of the stock is 50. The strike price is still 40. So the intrinsic value is 10. And at expiration, the extrinsic value, this time I said it right, is always going to be 0 at expiration. So that's not going to change. So that's the value of the call option is $10. So now let's think about what this means. John, in this case, he bought the call option for $5. And now it's worth $10. So he basically doubled his money. He received a 100% return on investment. But in the other two scenarios where the price of the stock went down from 43 to 40, he lost his $500 investment. And when it went from 43 to 35, the same is true. So it really doesn't matter how low the stock goes. The most that he could lose is his original $500 investment. Now let's move on to part D. If the price of the stock at expiration is $55, how much money will John receive if he sells the call option to close his position just before expiration? So the share price is $55 this time. The strike price remains 40. So the intrinsic value is 15. The extrinsic value will still be 0. So at expiration, the price of the call option will be $15. But we're not finished with this problem. So initially, John paid $500 for the call option. The price of the call option went from $5 to $15. So if he sells the call option at 15, keep in mind one call option controls 100 shares. He's going to receive $15 times 100 shares. So his account will be credited with $1,500. So he put in $500, he got back $1,500. His net gain is $1,000 on his trade. So now, what is his return on investment? By the way, the answer to part D is $1,500 because we wanted to know how much money will John receive if he sells the call option to close his position. He's going to receive $1,500. However, the gain on the trade is $1,000. So now going to part E, what is John's ROI in part D? His ROI, or return on investment, is basically his profit or his gain divided by the COI, his cost of investment, times 100%. So his profit in this trade was $1,000. The cost of investment, that is, he initially put $500 in to initiate the trade, so that's his COI, and then times 100%. So 1,000 divided by 500. If you cancel the two zeros, you get 10 over 5, that's 2. 2 times 100% is 200%. So that is his ROI on this particular trade. So thus, we could see that for option buyers, that is for those who buy options first and then sell it later. You can also do this in reverse, which I'll talk about in another video. But for option buyers, their risk in taking the trade is limited, but their reward is potentially unlimited because the stock price can go up forever. Now, granted, the probability of initiating a successful trade is not always favorable when dealing with options because you need to be right about the direction of the stock and also about the timing as well. Because let's say if the stock is moving up but it doesn't hit the strike price before expiration, your call option could still expire worthless. So let's say if the strike price is 40 and the stock is currently at $30. If the stock doesn't hit 40 before expiration, even if it's moving in the right direction, the call option can still expire worthless. So that's the risk of buying options and then selling it later, is that time works against you. So your reward is very high, but if you're not right, time decay can eat up the extrinsic value of the call option. So those are the risks of buying call options or put options too. You need to be right not only about the direction of the stock, but also about the timing as well. Now, there's 3 other terms that you may want to be familiar with when buying or selling options. Perhaps you've seen these abbreviations: ITM, ATM, and OTM. So you might be wondering, what do these 3 things mean? ITM means that the option is in the money, ATM means that it's at the money, and OTM tells you that it's out of the money. So let's use the same example where we have a call option with a strike price of $40. So I'm going to use ST to represent the strike price. So it's the same for all 3 examples. Now the call option is at the money if the share price is equal to the strike price. It's in the money if the share price is greater than the stock price, let's say 45. Now it's out of the money if the share price is less than the strike price. So that's how you can tell if an option is in the money, at the money, or out of the money. So when it's in the money, the intrinsic value of the option will be greater than 0. So in this example, it's $5. When it's at the money, the intrinsic value is 0 because these two are equal. And when it's out of the money, it's definitely 0. So the only value that at the money and out of the money options have are intrinsic values. I mean, not intrinsic, but extrinsic values, in which case their value depends on volatility and time decay. So keep this in mind. When buying at the money or out of the money options, even though these may be much less expensive, their price is greatly affected by volatility and time decay. Whereas if you choose to buy in the money options, the price of those options is less affected by volatility and time decay. It depends more on the share price. So in order to be successful at trading at the money or out of the money options, you need to be right not only about the direction of the stock price, but also you need to be right about the timing as well. Whereas if you buy the in the money options, timing plays less of a role. It's still important, but not significant. You need to be right mostly about the direction of the stock price. If you're right about the direction of the stock price and not so much about the timing, you can still profit with in the money options. However, your potential return on investment will be less compared to trading at the money or out of the money options. So these options, they offer a greater return on investment if you call it right. However, this one, there's less risk, but the ROI will be less because you're going to pay a lot more for in the money options since they're more valuable. Now, before we move on to number 2, let's discuss the differences between call options and put options. So as was mentioned before, a call option is a contract that gives you the right to buy a stock at a certain price, that is the strike price. A put option gives you the right to sell a stock at a certain price. Now, as was mentioned before, when the price of the stock or the share price goes up, the value of the call option goes up. In the put option, it's different. When the share price goes up, the value of the put option goes down. Conversely, if the share price goes down, the value of the put option goes up. So it's good to buy call options in a bull market when prices are going up, but in a bear market, it's profitable to buy put options when prices are going down. Now let's talk about why the put option goes up when the share price goes down and vice versa. It has to do with this formula. Recall that the intrinsic value of a call option is the difference between the share price and the strike price. So notice that we have a positive sign in front of the share price. So that means that we have a direct relationship between the share price and the intrinsic value of the call option. So that's why when the share price goes up, the call option goes up too. Now the equation is basically reversed for the put option. The intrinsic value of the put option is the difference between the strike price and the share price. And notice the negative sign in front of the share price. So that indicates an inverse relationship between the share price and the intrinsic value of the put option. That's why when the share price goes down, the put option goes up. Or when the share price goes up, the put option goes down in value. Now, the effect of volatility on the price of the call option and the put option is the same. When volatility goes up, the extrinsic value of the call option and the put option, they both go up. And for time decay, it's the same. As the time to expiration decreases, that is, as time moves forward, the extrinsic value of both the call option and the put option goes down. So the only thing that's different between call and put options is the direction of the stock price. If the stock goes up, the value of the call option goes up. If the stock goes down, the value of the put option goes down. But volatility and time decay has the same effect on call options and put options. So I want to give you a brief comparison between these two option contracts. It's important to understand these concepts if you're going to buy and sell options. Now, let's move on to number 2. Megan buys a put option with a strike price of $100. The price of the put option is $15 with a 1-month expiration date. The market price for the stock is $92. Part A. What is the total amount of money that Megan paid for the put option? Well, the answer is not $15 because remember, one option contract controls 100 shares. So it's going to be $15 times the 100 shares that the option contract controls. And so the total amount of money that she paid for this contract is $1,500. So that is her COI, the cost of investment. Now what about part B? Calculate the intrinsic and extrinsic value of the put option. Well, we know how to calculate the intrinsic value. For a put option, we said it's the difference between the strike price and the share price. So the strike price is 100, and for this problem, the share price is $92. So the intrinsic value of the put option is $8. Now to calculate the extrinsic value, it's going to be the difference between the price of the option and the intrinsic value of the put option. So the price of the put option is 15. The intrinsic value is $8. So the extrinsic value is $7. So let's think about what this means. So let's say if the price of the stock remains at $100. 1 month later, if it expires at $100, the price of the put option will be worth $8. The $7 that you see here, the extrinsic value, this is known as the time premium, or you could think of it as a time value of the put option. At expiration, that $7 is going to disappear. That's money that's going to go away. But right now, she has $8 built into this contract. So let's think about what that $8 represents. Keep in mind, the put option gives her the right to sell the stock at 100. So Megan can go to the market and purchase the stock for $92. She can then sell it, or she can exercise her right to sell the 100 shares that she bought at $92, and she could sell it at $100. And so she's going to make $8 per share, which is the intrinsic value of the put option. So now let's move on to part C. What will be the value of the put option if the price of the stock at expiration is $110? So let's use this formula again. Now keep in mind, at expiration, the extrinsic value will always be 0 because there's no time premium left in this option. So the price of the put option will be equal to the intrinsic value at expiration. So simply going to be the difference between the strike price, which remains at 100, and the share price, which is 110. So if you get a negative number, keep in mind this tells you that the intrinsic value is really 0. Therefore, the options contract expired worthless. Now let's move on to the second part of part C. That is, if the share price goes down to 80. So the intrinsic value is going to be the strike price minus the share price. So it's going to be worth $20. So thus Megan will realize a modest gain. She bought the contract for $15 and she can now sell it for $20. Now, if you want to calculate the break-even point, you need to find the price at which the intrinsic value equals how much she paid for the option. She paid $15 for the option. So if we set this to 15, we can solve for the share price, which is going to be the break-even point. And it's going to be 100 minus 15. So if the share price goes to 85, then the put option will be worth $15 at expiration. That means she broke even. She didn't make him any money on his trade, nor did she lose any money on the trade. So in order for Megan to profit, the stock has to fall below $85. That's her break-even point. If it closes anywhere above 85, she lost money on the trade. But the more the stock falls, the more profitable it's going to be for Megan. Now let's move on to part D. Calculate the ROI if the stock falls to $40 at expiration. So the put option is going to be worth 100 minus 40. So it's going to be worth $60 at expiration. And that's pretty good. But let's calculate her net profit on his trade. So her initial cost of investment was $1,500. That's how much she paid for the put option. And she's selling the put option at $60 times 100 shares. So 60 times 100 is 6,000. So when she sells it, her account will be credited with 6,000. Her net gain on this trade is 4,500, which is pretty good. So what is her ROI? Her return on investment. This is going to be the profit divided by her COI, her cost of investment, times 100%. So she realized a gain or a profit of 4,500. Her initial cost of investment was 1,500. And so her return on investment is going to be 45 over 15, which is 3. 3 times 100 is 300%. So that's her ROI on this particular trade. That's if the stock moves in her favor and in the right time, because it needs to go from 100 to 40 in a 1-month period. So in order for her to profit from this trade, she needs to be right about not only the direction of the stock, but also the timing. And to be right in both of those two cases is not always easy. So therefore, buying long call options or long put options, those are not high probability trades. The probability of making a return like this is not that high. It does happen occasionally, but not very often. And so it's important to keep in mind not only the potential ROI that you can make with these trades, but also the probability of making those returns, because the probability is higher that the contract will expire worthless than her making a huge return like this. So it's important to consider probability and not just the potential ROI. So that's it for this video. Hopefully it gave you a good understanding into the basic math behind call and put options and how much they're worth at expiration. So thanks again for watching. And don't forget to check out the links in the description section below for those of you who want more info on calculating financial ratios like price to earnings, price to sales, book value, dividend yield, and other things like that. So feel free to take a look at the videos in the description section below.